Hello everyone, here I come again. I'm going to teach you today advanced financial management. We have been doing some random questions towards the past papers from the advanced financial management. If you have reviewed my last video, we discussed about financial decisions, a chapter in financial management, advanced financial management. Today let us to go to another chapter called portfolio and capital asset pricing model, what we call CAPM. Portfolio and capital pricing. CAPM, capital asset pricing model, what we call CAPM on the same. You can start. All right. So our chapter every day is going to talk about advanced financial management. Financial management. Abbreviation is FM. And today we are going to talk about portfolio theory and capital asset pricing model, what we call CAPM, called CAPM. And this one, we're going to do I'm going to measure mostly about the portfolio theory and CAPM. I'm going to go straight to some past papers towards the question which has been set from portfolio theory. Sometimes it links up with the portfolio theory, links up with CAPM on the same, and the question how you can tackle them on the same. So we're going to start with the May KASNEB, May 2016, question 2A, May 2016. You write the question here, May 2016. We're going to talk about question 2A. May 2016, question 2A. Biashara Limited wishes to invest in stocks M and N in two different industries. The following information relates to the two stocks. As I told you previously in my classes, better you start with the question, read the question first without answering, maybe without analyzing. Then after you are through with the question, you can come back and start analyzing the question. So we are going to talk about the expected return in percentage. We have stock M, stock N. Then we have standard deviation, 8.6, beta coefficient, we have 1.8, 1.5. Amount of money invested, the total investment or this one, the combined ones is going to be 1 million. The stock of M is 1.2. The other one is 0.8, that is 800,000. This one is 1,200,000. The expected portfolio return, explain the effect on the portfolio risk if the returns of stock M and R were perfectly positively correlated. Include suitable calculation, that is Roman 2. Roman 3 is saying, Mapeni Limited Investment Fund comprises of 4 major projects. The details of the projects are as follows. The projects are going to have that one. Let me just finish up on the part A part of it, so that we go to the part 2. So we are going to have the part A. I can repeat the question as I've said. We're going to say, the question is asking, Biashara Limited wishes to invest in stocks M and N. We have two stocks. We're going to talk about the solution. Here we have stocks M and N. Then the following information relates to the two stocks. Expected return. The expected return, we have expected return from stock M is 18. Then this one is 16, the expected return. Then we are going to have standard deviation. You have standard deviation. Standard deviation. You are going to have for stock M is 8. This one is 6. Then you're going to have beta coefficient between the two. You're going to have this one is 1.8. This one is 1.5. This one is just analysis. Everything is given here. The question. Then we have amounts to be invested, amounts of money invested. Money, it's combination between M and N. So it's going to be M. It has stock M as 1.2 million. Stock N as 800,000. You can have the combined money invested between the two stocks. It's going to be 2 million. 2 million. This one is going to help you to find weights. The total helps you to find weights. This is majorly, you want to find the weights between the two, the proportion between the weights between the two. So, expected portfolio return. Here we come to the question. The question which is, that was just analysis. The required, the expected, we have expected return of the portfolio is given by weight. We have two weights of M. Expected return of M plus weight of N, expected return of N. That is how we get expected return of the portfolio. Don't be confused about expected return. Expected return sometimes we talk about in the summation. We talk about return times maybe probability on the same. But here we are talking about expected return of the portfolio. So sometimes that confuses many students about the expected return and also expected return of the portfolios. You can proceed from there. The weights, I've told you this one is going to help us to get the weights. So here to get the weight, we are going to get the proportions. So M is equals to, this one you can round off maybe to terms of millions. So you're going to get 1.2 divided by 2. This one is going to be N is going to be 0.8 divided by 2. So this one, after calculation, you take your calculator. You have your calculator here. You have 1.2 divided by 2. That you're going to get 0.6. 0.8 divided by 2. Last time I told you, you can take this one minus 0.6, you're going to get 0.4. After getting the first one, if you have gotten it correctly, the second one, you can calculate it maybe 0.4. All of it is going to be under 1. So it's a proportion towards it. So you're going to talk about this one, weight of M, of which weight of M we have it is 0.6 times expected return of M. Expected return of M we have here, which is 18, plus weight of N, 0.4, times expected return of this one is 16. 16 is equals to, can get the expected return of the portfolio in percentage, 0.6 times 18, plus in brackets, 0.4 times 16. You're going to get 17.2%. That is expected return of the portfolio. You are home with your 4 marks. Home with your 4 marks. We can go to Roman 2, or the part of the question. This one is asking about explain the effect on the portfolio risk if the returns of stocks M and N were perfectly positively correlated. Include suitable calculations. So when you are about to talk about positively, and it is perfect correlated perfectly, here you're going to talk about in the degree of positive 1. You're going to talk about is 1, but it's going to be perfectly, which is talking about positive. Sometimes it may be negative. When you have negative, you have negative 1, they correlated on the same. So the correlation here, part of it, which is denoted by R, you're going to have it is positive correlated between the two portfolios, not portfolio, the returns of the two stocks. So we are going to have, there's something here we need to talk about. It's talking about the effect of the portfolio risk. This is about the risk diversification. Risk diversification. This is given by weighted standard deviation of portfolio minus actual standard deviation of portfolio then all over actual standard deviation of portfolio. Sometimes you have to grasp the formulas when you are doing these questions. They are later, that's why I told you we are going to relate between the portfolio and also CAPM. We're going to apply CAPM part of it maybe later on. We're going to talk about CAPM part of it. That's why you're going to have the portfolio here. We're talking about portfolio. Then here we start with, maybe we can start with the actual standard deviation of portfolio, actual standard deviation of the portfolio. And we're talking about the portfolio is between the two stocks. We have the stocks we're talking about here, the stock of M and N. So when you have this one, this is the formula, it's very long, is the square root. We talk about weight of M, of which we have weight of M here, squared, standard deviation of M squared, then plus weight of N squared, standard deviation of N squared, plus 2. You have to be very keen. Because here we are correlating between this one, is about, not correlation, is about the risk diversification. You're going to find the standard deviation between these two stocks. We have to link this one with, we are going to include the weight part of it, the standard deviation part of it, and the third part of it. So we're going to talk about here weight of M, then we multiply also with weight of N, standard deviation of M, then we have standard deviation of N times, that is the correlation part of it, because we are being told the path, it is what, are perfectly positively correlated. The R part of it has to appear here. It's supposed to all of it. You are supposed to have a square root of all of it. So you're going to start with the part of here, weight of M. We have weight of M here, we end here. Is 0.6 times standard deviation of M. Standard deviation of it, you're going to have here, it is 8. And it is squared, don't forget to include that one. Then we have weight, that one was a proportion, squared, times the standard deviation of this one. Deviation is 6, squared, plus 2. So we're going to talk about the covariance part of it and the correlation. When you're going to have correlation, you're going to have the R part of it at the last. So we are going to have weight of M, of which is 0.6 times 0.4 times standard deviation of this one is 8 of M, 8 times standard deviation of that one is 6, if I'm not wrong, times 1. Because you're going to have this one, we talked it is what? Perfectly correlated, is positive 1. So out of this one, we're going to have the root part of it. This one, you need to be very keen about the calculation towards it. Squared times 8 squared is equals to 23.04 plus 0.4. I can advise you to be taking bit by bit towards this one. Don't calculate all of it. Maybe you are going to have a bracket, carry something like that. You may have some confusion towards it. It's better you take bit by bit. Then times 6 squared, this is going to be 5.76 plus, it's going to be 2 times 0.6 times 0.4 times 8 times 6 times 1. It's going to get 23.04. So we can repeat it again, 0.6 for you to be sure, times 0.8 squared, not 0.88 squared. Yes, 23. So this one, you're going to, you can add now. Add first plus 23.04. And out of which you take root. We're going to have this one. You're going to get it is you take 23.04 plus 5.76 plus 23.04. Root answer, you're going to get 7.2. 7.2. That is the actual. But we still need, for risk diversification to know about it, we still need the weighted standard deviation of portfolio, of which is given by weight of M, standard deviation of M, times, not times, plus weight of N, standard deviation of N. Weight of M is 0.6 times standard deviation of M, which is standard deviation of M we have is 8 plus 0.4 times this. The weight of n is 0.4, then standard deviation of that one is 6. We're going to have this one. This one you can calculate directly. You have open the bracket 0.6 times 8 plus 0.4 times 6. You get 7.2. So we still have this one. So to get a risk diversification, I can fix it here. Risk diversification, let me just write it under maybe abbreviation. You're going to get the weighted, which is 7.2, minus 7.2, which is actual, divided by actual 7.2 times 100. You get it is 100, it is, this one is 0. The 0 part of it shows is what? Like the way you are being told, is positively correlated. That's why you need to prove about it. The question is asking about to include suitable calculation to get it is 0. When you have a 0, it is what we call perfectly or positively what? Correlated on the same. So that is part of it. You had how many marks for that one? So far we have, this one was 4. This one is 6. So far you have 10 marks. Imagine, 10 marks, 10 marks. After doing those summation on the same. So let's go to the other part. This question had different parts. B, part of it. So we go to B, part of it. My Penny Limited investment fund comprises of 4 major projects. The details of the projects are as follows. We're going to have the details of the projects. The projects, I don't want to list them. This is a part of B of it. Then you're being told project 1, we have this one market value of the fund. Then we have expected return. Then we have standard deviation. We have coefficient of correlation of the market. We have blah, blah, a lot of things. Maybe the details. You have this paper you can read by your own. The figures. Then we have risk-free. I want to maybe list this one. Risk-free is given by 5%. There is something else which is called market return. Expected market return, we are going to have expected market return. Return of the market, sometimes we call it, is 14%. Then we are going to have a standard deviation. A standard deviation of the market is 13%. Standard deviation of the market, these are the listing, maybe in the part of it. The risk below, maybe the narration towards the table there. Then you're going to be told the beta coefficient of the investment fund. The beta coefficient of investment fund. Beta, here we have to calculate beta coefficient of this one. And the beta, you're going to talk about, it is the correlation. We are going to get you beta, forget beta, we have correlation coefficient, coefficient of correlation of the market, or the market times standard deviation of the market there, or standard deviation of that project, or maybe portfolio. Then you're going to have the standard deviation of what? Of the market, all of it. So this is the formula to get the beta. Beta is about the we are talking about coefficient of correlation. You multiply by the standard deviation of the project or the portfolio or maybe the market we are talking about. That's why we are not in it X, because there are many, we have 4 of them. Then we have standard deviation of the market. Here, we can start from the null to a null. So far, the standard deviation of the market, we have it. But here, we can get it from the projects here. The coefficient of correlation with the market, we can get it here. So here, we are going to have, for example, we are going to take like a projects. We are going to list the projects here. We have the first project is project 1. So to get this one, we are going to talk about 0.55 times the standard deviation of that project is 15. Then divide by division, just all the same. That's why I put it on the bracket. The standard deviation of the market is 13. I can list all of them, the two part of it, so that we do calculation at once. So you have 0.75 times 20 divided by, these are going to be constant all through, standard deviation of the market. Here you have 0.84 times 14. Then you divide by 13. Here we have for the fourth one, this is the fourth and the last on that bit, 0.62 times 18 divided by 13. We can start calculating maybe from the start. Yeah, we check the way it is, the bracket 0.55 times 15 divided by 0.55 times 15 divided by 13. We're going to get 0.3. Let's have in two decimal places, 0.75 times 20. We're going to get, this one is 15. No, I've not divided with the 13 part of it. It's just you have to divide by 13. It's equal to divide by 13. 1.1, maybe 5. 0.84 times 14 divided by 13 is 0.90. Maybe because you have said it's two decimal places, 0.762 times 18 divided by 13, you're going to get 0.86. Yes, those are the betas, betas of the betas for the project. There's something else you're being asked here about, is about, that is a beta coefficient of the investment fund. But this one is beta for each project. For you to get towards the investment fund, you have, it is about the multiplication between the market value of the fund times the beta, the expected beta. So you're going to talk about the market value here, market value, market of the fund in percentage. So here we have in 20 the first one, so it's going to be 0.28. The other one is going to be 0.17. It's about 28 divided by that one. That is going to be 3.1. The other one is going to be 0.24. I wanted to explain to you about maybe when you have these percentage in numbers, you're supposed to divide them by 100 to get the percentage. Then, here we are going to have the expected beta, the expected beta of the portfolio, expected beta. So it is multiplier between these one. So we're going to multiply this one, and I can multiply maybe 0.63 times. Be sure it maybe for reference. There are some people who join maybe classes late. This one times 0.17. We're going to have 0.9 times 0.31. This is going to have 0.86 times 0.24. So the multiplier here is 0.63 times 0.28. The first one is 0.164. Let's write the way they are. Maybe you may start rounding off and you affect in terms of accuracy in the end of it. So 0.1955. We need a summation here to know the expected beta towards that. The investment inclusive of these projects, all of them, 4 of them. So 0.31, 0.9 times 0.31 is going to get 0.279. This one is 0.86 times 0.24. We're going to get 0.264. Then you add plus 0.279 plus 0.1955 plus 0.1764. You're going to get the expected beta of this portfolio is that one. That is the answer, the correct answer on the same. So you have answered the part, that is B, that is Roman 1, B Roman 1. We can go now, you can proceed to the required Roman 2. By comparing is the expected return and the required return, advise whether the Mapeni should change the composition of portfolio. Sometimes when you are learning about this portfolio analysis, the areas you are going to talk about, you talk about Jensen's alpha, Jensen's, or what we call alpha, is given by, I can write it maybe here, is given by, we have alpha, it is denoted like that, it's given by RS, what we call, this is the risk-free plus the expected return of market minus risk-free times beta, part of it. Then, this one minus expected return. So this we are going to have it here. So we can, because this one is a comparison we need towards it. And there is a way you arrange it towards when you want to get the difference between that one, so that you know whether it is the market, it is whether it is overvalued, undervalued, or the same. That is the comparison we need from the Jensen's alpha. It is used for that comparison. So we are going to talk about, so we have project here. Project. We have project 1, 2, 3, and 4. Here we have expected return of the projects. We are being told expected return in terms of percentage. We have here is 10. Here we have 18. Here we have 15. And here we are going to get 13. Then we're going to talk about what we have told you. RS, what we call risk-free plus expected return of the market minus risk-free minus beta. And everything here is like we have it, because in terms of beta, here is a beta part of it, you're going to use this beta. For expected return of the market, you're going to use this one. So, it's going to be the first one. For the first one, it's going to be, we start with the risk-free. Risk-free is 5 plus, in brackets, expected return of the market is 14, minus risk-free, which is 5, times beta. Beta is 0.3, then you're going to get the answer there. The other one is 5 plus 14 minus expected return. Expected return of the market. Here is about, we're going to have risk-free expected return of the market the same. The risk-free here is just we are going to, it's like you are replacing. The only thing you are replacing here is about the beta part of it. So it's 5 plus 14 minus 5. We have 0.9 is equals to. Then we have 5 plus 14 minus 5. We have 0.86. We can calculate now. Calculate from using calculator now. You can use calculator now to find out the. Mostly, this one is referred as CAPM. They was talking capital asset pricing model. The formula we find for CAPM. We have the same formula. The difference between expected return and expected return. And also the difference between expected return and the CAPM. That's how we get what? The Jensen what? Alpha. So this one we are going to have, it is, if we get this one, we can multiply this one. We will replace this one in multiplication instead of maybe doing each and by one. This is like replicating it on all of the projects. Minus 5, you can start the bracket 14 minus 5, that is 9. But don't assume so much, plus 5, 14. So it is 14 all through, 14 times 0.3, that is 8. Sorry for that, 8.82. So this one is 14 times 1.5. Which is 16.1, is 14 times 0.9, which is 12.6. The other one is 14 times 0.86. This is 12.04. So here, to get the difference is supposed to be, you left this one from this one. So the difference here, alpha, is going to be this one minus this one. So we're going to take 10 minus 8.2. It's going to be 1.8. This one is 16. 18 minus 16.1. We're going to get 1.9. This one is 15. 15 minus 12.6. 2.4. This is going to be 13 minus 0.6. The Jensen is about the difference between the expected return and also the CAPM. That's what we've gotten about it. So we're going to have the comment part of it, because this comparison is talking about something. When you compare between this one, it's going to have the difference between the two. This one is going to be use calculator. Sometimes it's better to be sure about it. Yes, we have the difference here. There is a positive. This is overvalued. Overvalued. When you compare, it could have negative, could be undervalued. Overvalued, overvalued. All of them are overvalued on the same, the comment section towards it. That's what you're being told by comparing the expected return, the required return, advice whether the payment should change the composition of its portfolio. So if it is overvalued, you are going to have the right narration towards whether it should be changed or not, no, retained on the same. So the other question I want us to tackle is a continuation of portfolio theory and CAPM. Is a November 2019 question. November 2019 question. November 2019 question. Question 3B. I told you theory part of it, although theory part can make you see places. We should start with the theory part of it. Some people are good at theory part of it, but the practical part of it, like the analysis or the calculations, is going to make you scope some maybe marks. I don't want to call them free because you're going to work for them. You're going to get some marks on out of it. So we're going to talk about November 2019, 3B. As I've told you, we start with the what? The question. Reading the question. Duncan Kipchumba as an investment capital of 1 million, he wishes to invest the fund into securities X and Y in the following proportion: 200 in security X and 800 shillings in security Y. The return of these two securities depend on the state of economy as shown below. The state of an economy, we have boom, normal, recession. Probability, we have 0.4, 0.5, 0.1. Return on security X, for 18%, 14%, 12%. Return on security Y, it is 24%, 22%, 21%. Required, the expected return on the portfolio, 3 marks, correlation coefficient between security X and security Y. We have 4 marks. The previous one, we were being given the correlation coefficient between the two stocks. But here, it's like we are being asked about to derive maybe or to get the correlation coefficient between security X and Y. So the portfolio risk, the reduction risk is due. The reduction risk due to portfolio diversification. The job, then we go to C part of it. So we can finish up with the B part of it, then we can go to C part of it. So I've told you, again, let me just go to start analyzing the question now. The Duncan Kipchumba has an investment capital of 1 million. He wishes to invest. So the total investment, so this one is B. Maybe total investment, yes, is I told you the investment, we are given the total investment between the two, the combined investment is shillings 1 million. So you have to proportionate the two, between the two what? Securities. And you are being told the proportion between the securities. We have security X and Y. The security X has 200. Security Y has 800. All of it is going to sum up to 1 million. Like the way you have gotten here, it is 1 million. So, first of all, as I told you, you can find the weights here. The weights here towards the two. So this weight is going to be, the total summation is 2. Maybe I can to write in terms of 0.2 over 1. It's going to be 0.8 over 1. This one going to get what? I have to check the proportion there. 0.2 divided by 1. That is 0.2. A is going to be 0.8. You can go the longer way route method of dividing this one with 1 million. This one you divide with 1 million. They're the same. You're going to get the same answer. After all, by the end of the day, it's supposed to be 1. So we proceed. That is, it is analysis. Then we'll be told the return of these two securities depend on the state of economy. Then we have state of economy. We have 3 states of economy. We have boom. We have another state of economy which we call normal. And we have the aspect of recession part of it. So, and we have probabilities here. And we have returns of x and the returns of y. So yeah, in the time of boom, here we're going to talk about 0.4, here 0.5, here we're going to talk about 0.1. Returns here is going to be 18%. This one is 14%. This one is 12%. Let me copy it maybe for analysis when we have 24%, 22. This is not part of the calculation. This is just to copy in the question again for analysis. Then the first equation required, we are being required, the part of it, the first one, we are being asked about the expected return on portfolio, the expected return of the portfolio. We have talked about the expected return of portfolio is given by weight of, we are talking about here the security X. Then we are going to talk about expected return of X plus weight of Y, expected return of Y. And here, weight of X, we have it, which is 0.2 plus expected return. There is something here we don't have here. So we can start with the expected return. Expected return is given by what we call summation. We have return times probability. And we are going to talk about, for the first one, let's talk about for X. We're going to have the returns of X. We are being given, it is 18 times probability 0.4, then plus the boom, that is boom, we go to normal, we have 14 times 0.5, then we proceed also to the other part of it, recession, which is 12 times 0.1, all of it, you can get some for the X, as we go to the Y also 18 times 0.4, plus in brackets 14 times 0.5 in brackets plus 12 times 0.1. That is 15.4%. We can go to the second one. Go to the second one. My board is small. We're going to adjust. For Y, expected return of Y is given by expected return of Y, let's go again, is going to talk about 24 times, so we're going to have summation 0.4 plus 22 times 0.5 plus 21 times 0.1. The summation there, we need to get the summation there. Yeah, 24 times 0.4 plus 22 times 0.5 plus into brackets 21 times 0.1. You're getting 22.7%. We can come back to our analysis here towards expected return of the portfolio. So already we have expected return of X and also Y. So expected return of X is 15. This is a multiplication, multiplier 15.4 plus the other is 0.8 times 22.7. Yes, 22.7. We get this, the total there, the total here towards expected return of the portfolio 0.2 times 15.4 plus in brackets 0.8 times 22.7. We're going to get 21.24. That is the expected return of the portfolio. Sometimes that's what I was telling you, we have to be clear. We are talking about the expected return of the portfolio and also expected return of the what? Of the maybe of the portfolio and also maybe the market or something like that. That's why you have the expected return times what? Summation in bracket return times probability on the same. The expected return of the portfolio. We can go to the second question. Maybe the second question part of it be the correlation coefficient between X and Y. Yeah, it has some 4 marks, but you have to toil for it. So we are going to talk about correlation coefficient. This is denoted by R, is given by the covariance of x, y. Then we have standard deviation of x. Then you multiply by the standard deviation of y. Then we come to covariance. The covariance between, we can have covariance of x and y. The covariance between the two, x and y. So we are going to, it is about, we talk about the expected return, the summation of expected return. Then all of it, we have probabilities towards it, towards the end of it, between the two. We are talking about the two here. We have in the expected return of security X and also expected return of security Y. So that is a correlation coefficient. That is the formula, covariance of X, Y, and what? Standard deviation of X and what? And Y. So we are going to talk about, we are talking about the covariance. It's supposed to be covariance between the two. So we are going to talk about is given by the summation between this one, the return of this one, and also the return of this one. It's supposed to be like a multiplier here. But we're going to analyze it maybe bit by bit. So we have the return of x. The x is, the return is 18. 18 minus expected return, which is 15.4. Then this one is, the second one is 14 minus 15.4. The other one is 12 minus 15.4. Then you multiply with the other return because this one is conjoined. So this is a multiplier. We have, the other one is, we're going to talk about the 24 minus 22.7. Then we have 22 minus 22.7. Then you are going to get the other last one is 21 minus 22.7. It's about the return. The way I've said the return, expected return of this one, expected return of this one. Then you multiply. Then you have the probabilities 0.4, 0.5, 0.1. This is the covariance. The covariance. I've told you this is one of the longest methods are towards finding the correlation coefficient. We have the covariance over standard deviation. So let's first get the covariance between the two securities. So we start in brackets 18 minus 15.4. You multiply, you open the bracket 24 minus 22.7. Then you multiply by 0.4. This one is 3.52. 1.352. This one you're going to have 14 minus 15.4. You close the brackets times 22 minus 22.7. Answer. I have not opened the bracket from the start. 0. That is 14 minus 15.4. Multiply by 22 minus 22.7. Answer times 0.5. It is negative 0, negative 1, 0.5, bracket 12 point minus 15.4. Then you multiply by 21 minus 22.7. Answer times 0.1. You get 0.578. Then you take the summation. We have summation part of it here. The summation, you can repeat this one. I have some doubts, but I can try again to check whether it is correct. 15.4. I'm not confirming because it has negative. I want to confirm the accuracy towards it. You can get negative 0.5. Getting a different answer, 0.4. Let me just compare and to be accurate about it. 14 minus 15.4 times 22 minus 22.7, which is expected return, answer, times 0.5. Yes, that's why I've said I need to confirm this one. 0.49 plus 1.352 plus 0.578 is 2.42. That is, we have covariance on the same. So after this, we are going to have standard deviation. The standard deviation of x is given by, we have root, summation, return, minus expected return squared. Then we are going to have times what? Probability. That is what we talk about the standard deviation. That is the formula. This is supposed to be all through. So we are going to start with the first one, x, which is, we can pick from here. This, you know, this is just duplicating like this one, but we are going to have a squared part of it here. So it's 18 minus 15.4, then squared. Then the probability is 0.4. You're going to have the other one is 14 minus 15.4 squared, 0.5. Here, this one we can get from 12 minus 15.4 squared times 0.1. Then after this, we get the summation. Then the summation, we get what? The square root on it. So 18, 15.4 squared times 0.4. We're going to get 2.74. 14 minus 15.4 squared times 0.5, we get is 0.98. They are going to get 12 minus 15.4, answer squared. Excuse me, let me do it again. 15.4 squared times 0.1, you're going to have 1.156. You can take the summation between the two, then you take the square root on these, plus 0.98 plus 2.704 is going to be 4.84. The root of it, the root of answer, going to get 2.2. 2.2, that is the standard deviation of x. We can go get now the standard deviation of y using the same formula. So standard deviation of y is given by, we have said the standard deviation is given by root. So we have summation, return of y, expected return of y. Then we are going to talk about squared multiplied by probability. So that return of x, we can duplicate it from here. It's 24 minus 22.7. The other one is 22 minus, I can complete it the 0 point, the probability 0.4. This one is 22.7. This is squared, probability is 0.5. This one is going to be 21 minus 22.7. 0.1 is equals to this text, so that we have the summation here. I can change my biro here. I can see this one has started being faint. The clarity is compromising. Squared times 0.4. This one is 0.676. Yeah, 22 minus 22.7 squared times 0.5. This one is 0.245. You're going to have 21 minus 22.7 squared times 0.1. We're going to get 0.289. Then you add plus 0.245 plus 0.676, 1.21. Then you take root of that one, you get is 1. So the standard deviation of y is 1.1. Still in the same question, So the correlation correlation coefficient, this one. So we are going to talk about R is given by, so covariance. Covariance is 2.42 all over standard deviation of X, which is 2.2 times 1.1. Going to get is what? Going to get is what? Times 2.2 and 2.42 divided by answer. It is 1. So this one is what we call positive, or what we call perfectly correlated. We have 1 positively or perfectly what? Correlated on the same. So that is a portfolio risk. Then we are being asked about the reduction risk used in the portfolio. That is a 2 mass. You can imagine that calculation has given us what? No, that is the correlation coefficient between the security Y and X. Then we are going to talk about the portfolio risk. The portfolio risk here, I want us to talk about portfolio risk. I can maybe I can try to fix it here. Portfolio risk. The portfolio risk is given by is given by, we talk about weight of we're talking about the two securities X and Y, with X standard deviation of Y of X squared, then plus weight of Y squared, standard deviation of Y squared, plus you're going to have 2 weight of X, weight of Y, then you're going to have a standard deviation of X, standard deviation of Y, times this one, correlation we have gotten above here. So that is the risk we're going to talk about it. So this one, this most of the time we call the actual risk, the actual risk. That's standard deviation of the portfolio. So we can start here. Weight we have it. We had already weight for X is 0.2 times standard deviation of X. That's why we need to calculate everything here to get the standard deviation of X is 2.2 plus 0.8 times, this one is 1.1, this is supposed to be squared, don't forget, plus, this all of it is on the root, then plus 2 times weight, 0.2 times 0.8 times the standard deviation of this one. This one, X is 2.2, this one is 1.1 times 1. Because of what? The correlation coefficient we have gotten here, the above. Like I've told you, we can start with this one, squared times 2.2 squared. You get, this is 0.1936 plus 0.8 squared times 1.1 squared. You get is 0.7744 plus 2 times 0.2 times 0.8 times 2.2 times 1.1 times 1. 1 times 1 has no effect over it. So 744, this one is root also. Sorry, times 2, this one, because I already have it. We're going to talk 0.936 plus 0.7744 plus 0.7744. That is going to come to 1.7424. Then you take the square root of it, square root of that one. You get it is 1.32. That is the, portfolio risk. We have reduction risk. The reduction risk here, you're going to talk about, we have talked about you can get the reduction risk or risk of diversification is given by weighted, this is a weighted standard deviation of portfolio minus actual standard deviation of portfolio all over actual standard deviation of portfolio. So underweighted, I said weighted standard deviation of portfolio. The standard deviation of portfolio is given by weight of X, standard deviation of X plus weight of Y, standard deviation of Y. Of which here we have weights is X is 0.2 times standard deviation of X is 2.2 plus 0.8 times 1.1, is it? It is somewhere here. Yeah, this one, 1.1. So that's what you're going to get. That is the reduction in risk due to portfolio diversification. 0.2 times 2.2 plus in brackets 0.8 times 1.1. You get it is 1.32. So after getting that one, we need to replicate it here. We have everything. This is the weighted or standard deviation of portfolio, which is 1.32 minus 1.32, which is actual. This is the actual minus all over 1.32. You have gotten times 100. You have gotten what? It is what? You multiply by 100. The space is small. You're going to get a 0 here. So that's why I'm saying it is what? When you have perfectly correlation, the risk of diversification is going to be 0. So this one is 0. That one is 0. You have all your marks, but I can see sometimes the examiner can be funny. Not funny. Maybe cunning. They're giving you only 2 marks for that workings. Imagine. Sometimes you need to be very conversant about the formulas and everything, maybe, for you to arrive at that point. So we can go to the last part of it, of which is part C. The question was very long. So Job Cheng, an investor, believes that there are 3 important factors that determine the expected return of a particular common stock. Job uses the following factor betas and factor risk premium. We have factors, here's factors here, 3 of them. We have 1, 2, and 3. We are going to have factor beta. Let me just copy the way it is here so that we analyze it together. The 1.2, this one is negative 1 point, that is beta, 0. Then this is 0, 0. Though 0 when it is on the right side has no effect at all towards maybe the number, the risk premium. If you have been conversant with the CAPM, capital asset pricing model, there is something which rings in your mind when you hear about the risk premium part of it. We'll be talking about the CAPM. So the risk-free is all through. Risk-free is given by rate is 5%. So when you talk about the premium part of it, there's something I want you to understand before we proceed. The premium, when you talk about the premium is given by expected return of the market minus risk-free. This is what we call, this is equal to premium. So in short, here, the expected return and the risk-free has been included in this part of it, so that you get the premium. This one, so you don't being surprised where we're going to get in this one. Because most of the time we're saying, we're talking about CAPM is given by risk-free plus expected return of the market minus risk-free minus beta part of it. So when we have this in between, this is what we call the premium. We are talking about the premium. This is the premium, and this one has been calculated for you. So we're going to talk about the risk-free, the expected return for the stock using the arbitrage pricing model theory, arbitrage pricing theory model, ATP. ATP is given by risk-free. It's more or less of the CAPM, but we are going to talk about the difference between the two. Expected return, maybe you are going to talk about it has how many model, maybe 1. Expected return is all through because we are going to have expected return towards it. The expected return. Then we are going to have here, when you have the formula, the formula we are talking about this one, you're going to talk risk-free. Then beta 1, then plus expected return. I'm just trying to draft the formula for arbitrage pricing theory. This one is beta 2, Then you can proceed. You have expected return of market. This one, risk-free, is a beta what? 3. So, and you can proceed. This one you can be continuous to many what? Portfolios, or maybe to many returns or the same. So on this one, we are going to omit this part of it. We are going to replicate it with what? The risk premium towards the factors. So we are going to talk about the risk-free. For the first one is 5 plus the expected return. This one is what we are going to talk about, 2.5. Then you multiply by the beta, which is 0.7. Then after that, you're going to have the second one, this one. You're going to have, it is 5 times 1.2. Then we add, the other one is going to be 6 times negative 0.1. Yes, I can calculate on that one. We find what is the answer towards it. We can start with the first one, 2.5 times 0.7 plus in bracket 5 times 1.2 plus 6 times negative 0.1. Yes, then plus 5. So you're going to get here a bit sage is 12.5% part of it. We are being asked about the expected return for the stock using the arbitrage pricing theory. That is it. Then there is something else here, the last part of it. We are concluding on it about the pricing portfolio, the other capital asset pricing model, what we call KASNEB. That was Roman 1. Roman 2 is asking the differences between what? The capital asset pricing model and what? And arbitrage pricing model. So we have KASNEB. So this is the theoretical part of it. I'm going to attempt maybe arbitrage pricing model, this one. ATP, no, we're going to have APT, yes, it's supposed to be APT, arbitrage pricing theory. So the first one, it is about the comparison. Sometimes the time is being based on what is being done. So this one, when you talk about KASNEB you say single factor model. But here we talk about is multi-factor model. It is multi-factor what model. The other one we can talk about, it uses what we call KASNEB. Most of the time we are being told it uses the security market line equation. Using security market line uses security market line equation. This one, it uses what we call capital market line equation. Uses capital market line equation. I'm going to abbreviate this one. You can find on it, maybe we were talking about the security market line equation, capital market line equation, or the same. This one is a single period. Don't be confused between factor and single period. This one is factor period. Factor period. No, factor period, yes. Period and the same. Those are, they only asked about the two. If you give it two of them and maybe just listing them, you are home and try your maths about it. Yes, that is a portfolio theory and also capital pricing model, capital asset pricing model on the same. And that marks the end of our class today. Thank you everyone for watching. Don't forget to subscribe, like, share. We're going to have more of these. Thank you and bye.